So let's get back to basics. Taxable income. So taxable income is the income on which tax is levied for every individual in Australia. It's a construct of our tax law. So basically, as a function, it's the sum of your assessable income less your allowable deductions. And all of these concepts are picked up in our tax law. So to the extent you need any guidance, that's probably the primary source of that guidance. It's not rocket science. You basically add up all of your assessable income. So for example, your salary and wages for the year, you add up all of your deductions for the relevant income year, and then you subtract your deductions from your assessable income to result with your taxable income, on which then your tax is levied at your individual marginal tax rates. But today we'll talk about some deductions. So in our tax law, we've got two types of deductions. We've got what we call the general deduction, which is often referred to your 8.1 general deduction provision. And then we've got some specific deductions, which are those deductions that are expressly included in our tax law outside of that general provision. So self-education deductions fall within that first component. So general deductions are effectively deductions for any loss or outgoing to the extent that it is incurred in gaining or producing your assessable income. So being an individual, the loss or outgoing must be incurred in gaining or producing your assessable income. There's also a negative limb, which we'll come to. You cannot deduct, so you're denied a deduction to the extent that it is a loss or outgoing of a capital or of a capital nature, or of a private or a domestic nature, or otherwise it's related to producing exempt or non-taxable income, or another provision of our tax law precludes you from deducting it. So basically what this means is that the general deduction provision, this 8.1 provision, is broken up into two key concepts. We've got this positive limb, which gives you the gateway into the deduction. So you can deduct loss or outgoing occurred in gaining or producing your assessable income. But then we've also got this negative limb that then takes you outside of this provision if the loss or outgoing is capital, private, or related to non-taxable income, or if the tax law otherwise prevents you from deducting it. So let's just touch on the positive limb and the key components in this limb. We've effectively got two things that are allowable deductions under this limb. It's a loss or it's an outgoing. An outgoing is another word for a payment, some sort of expenditure, basically an outgoing of yours, so something that you're parting with. And then a loss is meant to encompass things that where there's no payment. So for example, if something is stolen from you or involuntarily required or paid or whatever, the loss is meant to basically address that and capture that into this deduction provision. Then we've got this concept of to the extent that. This phrase is basically requiring there to be a connection or a nexus between the deduction and the gaining and producing of your assessable income. Aside from requiring a connection, it also allows you to get a deduction to the extent that it's relevant for gaining or producing your income. For example, if you've got an outgoing or a loss that is related to your income, but also to private purposes, then you have the ability to what we call apportion. And so the component of that loss or outgoing that's relevant for your income producing purposes, you still get a deduction for that. It's I think a very flexible provision in the sense that it gives you the ability to apportion between deductible things and non-deductible items, even if it's just the one expense. That last line there, I've put in a little bit of a comment to let you know that the apportionment must be reasonable. So it will highly depend on what we're talking about. But for example, if you're traveling to undertake a course in another city and you don't live in that city, then the travel can be deductible potentially. But if you're tacking on a private holiday at the end of the trip, then all of a sudden you've got not only income producing purposes, but you've also got private purposes. And so to the extent that phrase basically allows you to apportion between the deductible component and the non-deductible component. The second part of the positive limb is probably the most important, particularly in your context. So the deduction must be, or the loss or outgoing must be incurred in gaining or producing your assessable income. So there's no definition of what this means or what it requires, but as a general concept, basically it needs to be incurred in the course of gaining or producing your income, or have the essential character of being related to an income producing expense. So again, it's like coming down to that concept of, is the outgoing or loss connected or relevant or incurred in the course of you gaining and producing your income? So for example, I specialize in tax. So if I do a tax related course that will improve my skill in my current role, I mean, you can see how that is connected to my income producing activities, because income producing activities, salary and wages, and I am undertaking this study or qualification to basically better my skill. And why is that relevant? Because my skill is what is generating my assessable income for tax purposes. Synonyms for this basically like connection, relevance, incidental. That last line there is just a contrast note. So I spoke my example about practicing in tax law and having a current role. Well, if, for example, you are unemployed and don't have a current role, or you'd like to change and acquire a new role, then the expenditure or the loss or outgoing couldn't necessarily be incurred in gaining or producing my assessable income, because at that point in time, if I have no job, there is no assessable income. Or if I want to get a new job, which is materially different to my current job, then it's not really incurred in producing my current assessable income. It would be considered, I guess, too far removed or too soon, because the new role is is basically the objective in that example. Then we've got this negative limb in this deduction provision. This negative limb basically pulls out certain expenses. So this one says you can get a deduction under this provision, except to the extent that it is capital, private, or related to gaining or producing exempt income or prohibited by a tax law. Now, the first two are clearly the most relevant to your circumstances. So what is capital? Capital, we like to extinguish capital from revenue. So my best analogy that I like to use is capital is basically the infrastructure. I like to use the example of a tree. So capital would be the tree, and then revenue would be the apples or the fruit that the tree produces. So the capital is basically this enduring benefit, once and for all profit yielding structure. It's the infrastructure. And then the revenue is like your profit, your revenue for the year. It's the fruit that you harvest from the tree. I hope that analogy lands, but essentially a capital expense might be like an outgoing or your payment for a computer or a desk or a calculator. And the reason why is because those are enduring benefits. They're not something that you would essentially, you're not like trading in computers, for example. It's not trading stock, it's not revenue. And then the private component is basically anything to do with you personally or privately is not deductible. And you can understand why, because it's not relevant to an income producing purpose whatsoever. So for example, generic clothing or your haircuts or parking fees, your rent, they're all private personal expenses that you shouldn't otherwise get a deduction for. Now, obviously, there's always a carve out for these types of things. So for example, if you're paying rent, but part of your home is used for income producing purposes, then there's a world where part of that expense can be deductible. But generally speaking, the purpose of letting you know that private expenses generally, the default position is that they're not deductible. And then you can see if there's any exception to that general rule.